Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. We have Bill Condon and Matt McGregor, and today we have Nicole Sayers joining us to talk about the debt markets. Nicole is a senior vice president with us at Colliers. She's in our San Francisco office, works on a great team, and has been really in the debt and equity space for close to 20 years, but only at Colliers for about 3 or 4 years now. Is that right, Nicole?
That is right. I was fortunate to start February of 2020.
What a great
Oh,
time
fun.
to start. Wow, what a ride it's been in the debt market since then.
It has.
I saw you're a University of Arizona graduate.
That is correct.
So tell us how you ended up in San Francisco and how you ended up at Colliers.
Yeah. So, really quick story. I'm actually born and raised Milwaukee, Wisconsin. I did not like the cold and gray, so I applied to one school, and it was the University of Arizona, sight unseen, but I knew it was
Wow.
warm. Yep. And I went there and lived for 15 years. And I met my husband down there. He came down. He was a bike racer, and he ended up we went on a date, got married, and moved up here where he is born and raised. And we live in Sacramento now. I work between the San Francisco and Sacramento offices. So just a quick wild ride.
How was that first quarter at Arizona? Never being there prior, it must have been like 115 or something. First
Yeah.
month or
So,
so.
I came from Milwaukee where on one given day it could be 99 degrees and 100% humidity and then 60 degrees and sleeting at the same time. And I got in a car and drove there with a friend. And I played soccer there. So we had
Wow.
soccer practice from 4 to 6 in the afternoon
Ooh.
in August. It was definitely, I used to put my hand on the back of my neck because it would be so cold and it felt so good. And I later found out that was not good. Dehydration.
Yeah.
Right.
What
Oh my
position did you
gosh.
play? Center
Left
mids?
left back.
Oh, okay. Yeah.
Back.
Yeah.
Yep.
Yeah.
Awesome.
Awesome.
Impressive. Well, Nicole, no major changes in your market over the last year, right?
Nothing. No, we just sit back
No
and
news
watch
here.
deals close, right?
That's right. Yes. Well, let's talk a little bit about the current situation related with commercial interest rates. Where kind of where we've gone over the last year and a half with all these changes and where we're going.
Yeah, I think the biggest takeaway with what's going on in the markets and where we're at with commercial interest rates are, looking at the historical. Listen, through COVID in 2020 and even part of 2021, the treasuries were unheard of, right? We have never been that low. That's what made your guys' world fantastic, right? You
Right.
got to sell products at a sub 3 cap rate and people could still get debt and it made sense. Um, Unfortunately, those times couldn't stay, and we had to move back, and the pendulum started to swing quite swiftly. But from last year at this time, actually to date, we are just over 100 basis points higher than we were last year. But at the same point in 2022, we were almost 200 basis points higher than where we were in 21. So, in the markets today, we've seen over the last few months over 4% on a 10-year treasury, just barely hit over. And we're back down right now. I think today we're at 3.5. This is a pretty normal space for the treasuries. The problem with it is the treasuries are so up and down right now because of rhetoric in the marketplace that the lenders out there get a little bit weary. So the initial issue with rates today is lenders are expanding their spreads, whereas we're all simply waiting for them to start compressing. So interest rates are staying in the sixes right now. We've heard of a couple flirting in the fives still. Um, there's a lot of the smaller lenders that we were relying on through COVID that are up in the sevens. And those are smaller banks that are having to pay a lot more on cost of funds. But interest rates as a whole today compared to a year ago, obviously they're much higher, but we don't anticipate them really going much more than they are. we're hoping that once the Fed stops making their changes and the markets are a little bit calmer, that the lenders will start compressing their spreads back to what used to be like a 160, 180 spread, which right now is upwards of a 300 spread. So pretty big.
That that is a lot of changes in your world and obviously our world and our listeners' world. Talk to us a little bit about how challenging it is, to get a commercial debt, say on an industrial building today versus a couple years ago. And my second part of that would be specifically talk a little bit about spec development because as industrial brokers, tenants, buyers, capital markets, you know, we are trading a lot of those type of buildings and we're hearing that it is very difficult to get debt for spec projects. So talk to us a little bit about that.
Yeah, well, just to start on non-development, what we're seeing at least today, a little bit better than I would say maybe 6 months ago, is that sellers are having a little bit of a realization, right? The sellers were looking at how people were getting, like I said earlier, the sub 3 cap rates on their buildings, and they thought, well, I should get that as well. Well, when interest rates have gone up as much as they had, obviously buyers and sellers had very different opinions on that. Um, the difference right now on us getting, you know, debt for our clients on the industrial side is there's a lot of value add that's out in the market that's for sale. And lenders aren't necessarily as bullish as some investors on the market rate going up as much as they say it's going to. So when you have leases that are rolling in 2 and 3 years, you have a seller saying, "Hey, I'm going to give a buyer the upside." The lender is saying, "Well, what if that upside doesn't happen? All of a sudden, we are upside down." Right. So I think that's the biggest challenge right now on getting debt. So we're really looking at the value add type properties are 3 year. You can get 3 year debt even with banks, debt funds in banks, but we're having to look at doing some floating rate debt on that. And then also lower leverage. And the lower leverage is simply the lender saying, hey, we just don't have the same thought on where market rents are going to be when those leases roll. On the development side, it's very different. You would think with interest rates being as high as they are, and development is based on obviously floating rate deals, construction. SOFR was at 0.05 this time last year, 0.05. Today we're at 4.8. It's a
Wow.
little bit different,
Jeez.
right? That's because every time the Fed raises the federal funds, generally SOFR, and for those of you who don't know what SOFR is, it's replaced LIBOR. It's the secured overnight funds rate. SOFR generally goes up almost identical to what the Fed increases rates to. And I'll come back to that as far as the treasuries. But the SOFR rate being 4.8, if you're looking at non-recourse debt and construction, and a good day, you're going to see maybe 4.5 over the SOFR. So you're already well over 9% on construction
Whoa.
debt. And that's not spec debt. That is, we've got a lease in hand. This is good scenario. When you're looking at speculative development, the market again is you hear Amazon giving back space. Depending on where you're at, some lenders will just be very weary. We we are currently in a spec development deal just outside Salt Lake City. What has gotten that deal over the finish line for us is one, it's a smaller sponsor and they chose to go with recourse on this. And that was simply because the difference for them with it being spec development was it was either going to be 6.5 over or it was going to be 3 over. And that difference in interest rate, they were willing to take on the recourse. That said, regardless of recourse, the lenders that were looking at this were comfortable with the spec development because they have a really good leasing team that they've already engaged with. That team has shown what's out in the market, who is out looking, the space and needed, and they've really worked with our client on their space plan. Originally, they were looking at having 7 units within the building, 1 to 7. The leasing team said, no need for that. Let's do 1 to 4, max of 4 people, 4 groups in the building, because that's what's in the market and needed. If you have all the details up front, it's a lot easier to get that spec development through with a lender. If you're just saying, hey, we're just going to take a chance in the market to see what's around, that's where the lending becomes a lot tougher to get done. And then again, certain markets, if you're in a market right now where there's a lot of, large box retail, and Amazon has maybe moved into one or two of those, and they're talking about giving one of those back, it's going to be a lot harder for a lender to come in and say, we're good with spec single tenant industrial today in that market.
So just to finish that thought, just so I'm clear on exactly what the interest rate would be, let's just take a prime location, prime leasing team, but it's a spec 500 in the Inland Empire, known market, proven market, known developer. It's, Panantoni or somebody like that. You're talking 9% plus what?
Oh, no, not plus. So you're
Okay.
talking
Okay.
9% all in. Yeah,
9%
full
all in.
coupon, yeah.
Okay. Okay. Got it.
No, so
And
the
it,
480 plus a spread. And, again, if you're looking even at a 4 spread, you're just, kissing 9. And if the Fed goes up again, which right now all indications show 86%, I think today shows that they'll go up another 25 basis points, that'll push SOFR over 5%.
and what was that same deal? If it's 9%, around 9% today, what was that same deal at the leanest interest rate at the top of the market a couple years ago or whatever it was?
I can give you exactly. We did
Okay.
another deal. Unfortunately, it was multifamily, but multifamily and industrial on rate wise, they're very similar.
Yep.
In October of 21, we closed on a north of $30 million, 65% loan to cost multifamily with a bank, non recourse. And it was SOFR plus 235. SOFR at the time was 0.05. So they were at
Wow.
2.4% and they had a cap
Wow.
on it. So, there's the difference on what makes sense and what doesn't.
That's incredible in such a short amount of time.
Yes.
So there's been so much change. I guess the question is like, how are you seeing investors react to this change? And then kind of what trends are you seeing take place in the marketplace as a result of these changes?
Well, I'm sure you guys are seeing the same thing as we are. There's a lot of pause right now from investors. Everybody still wants to get their capital out. Everybody still has a business plan. They still have to get back their returns to their investors. But it's harder to make a deal work, right? You look at the returns and they're not penciling the same when you're looking at a 9% construction loan versus a 2.5% construction loan. There's some pause, but I think at the end of the day, the groups out there that really want to continue, and which are a number of them, of course, to continue to dive into this market, they're just looking at, okay, we're going to have to go in it with lower leverage. So whether we have to bring in an equity partner, whether we have to potentially bring in a mezz or pref component to it with our senior lender to get over that 50%, maybe they need to have 65. There's a lot of creativity that's happening to make deals work. And that's really where we come in the most need. I mean, you would think we would have thought, I guess, a year and 2 years ago, we would have been the busiest ever because you hear of COVID and everything's going wrong. Well, unfortunately, we weren't as needed at that time because everybody could get lending from anywhere. Well, now you've got, the regional and community banks who were making up a very large portion of the lending over the last few years. They're taking a bit of a pause, working with their clients, assessing their internal portfolio. And, CMBS, nobody wants to go into it anymore, although they're the ones who are, for the first time, getting creative on getting deals done because they really need to get some powder out. Insurance has also, I think the word here, creative, is the one that we just keep going with. People are finding a way to get it done, but it is challenging.
On that, Nicole, how do interest rates and inflation affect the debt and equity markets, and how do investors today take those factors into account and make sound investing decisions?
Yeah, I mean, the interest rates, we touched on this earlier, the treasuries don't correlate the same with what the Fed does, whether they raise rates or not, right? It's already been baked in. So we know today, it's like I said, 86% chance that we're going to go up a quarter of a point, I think in 12 or 13 days when the Fed meets again. The treasuries are already, that's already baked in there. So what we'll see is if for some reason they come back and say they're going to lower by 25 basis points, you might see the treasuries spike. It'll be a short term, reactionary piece, but then they will come back down. The That being said, of course, the Fed's working through whether they're going to raise rates or not to curb inflation. I think we're in such a weird time right now. Even economists are struggling with figuring out like how does this all work and why. To come back to it though, I think investors, again, this goes, I hate to keep using the same word, but creativity, right? A lot of the things that we're seeing now is a 5-year debt. So whereas some groups would go into let's call it a core property and they say, hey, we've got a 15-year triple net lease, single tenant, it's 2.5, 3% bumps. We're good. We just want to park some money. We want a 10-year fully fixed, full term IO deal. That's all great and wonderful, but there's not a lot of those out there right now. And so when you're looking at all the value add pieces, some of these groups aren't also wanting to pay the floating rate debt because SOFR is so high. So we're seeing some groups actually determine in their business plan they can do a 3 to 5 year fixed rate bankroll or insurance. CMBS has even come down and said, hey, we're looking at doing some 5-year debt and trying to get a little bit skinnier on our spread to make sense for the numbers. But I think that's the biggest one is looking at shorter term fixed rate versus floating rate debt, because the floating rate debt just doesn't make sense on most deals right now. And so I think that's where investors are having to look. And then again, being comfortable with just seeing a little bit skinnier returns than what they would really like to see.
So we have all this change going on right now, right? And pretty soon we're going to be in an election year again, right? So let's talk
Sometimes.
politics now. But like, how does political, I guess I would call it uncertainty, impact the debt markets?
Yeah, I think anything. I mean, this is unfortunately a touch more on a personal, thought. But you look, I'm just like right now scrolling Wall Street Journal, right? So every morning, wake up, throw this up on my screen, and it's basically one of the better ones that we use for figuring out what's going on in the debt markets, right? Because you can kind of follow what's going along. My thing that I was laughing at to myself today is there's not one article on here about COVID. I mean, we went 3 solid years where
Right.
somewhere on everywhere there was a thing about COVID. People aren't going back to work because of COVID. COVID's creating all these issues. Everything today is the SpaceX Starship explodes, right? Journalists that are being imprisoned, the Ukraine war that nobody really talks about, even though there's actually a war going on in Ukraine right now. All of these things affect the markets. But again, at the end of the day, it's, the treasuries are going to just kind of follow what the market news is. Sometimes you'll get a spike for a couple days and then usually you'll see a reprieve. Sometimes you'll see a drop for a couple days and usually you'll see a reprieve. So anytime there's a big announcement, you'll see a quick change and then it just kind of like floats back out. The political piece is one that I feel we're going to start seeing that ramp up here, in the next 2, 3 months. And again, it starts to get baked in. People's expectations are what happens with the indexes. Most commercial real estate, and I guess I should have started with that. Most commercial real estate indexes and things are monitored off of are the 10-year treasury. It's just the simplest way to go, right? It's the one thing that is historical that we have a lot of data on and we can follow it through. That's what we base most things on. Right now, we're seeing everything in the markets based on the Fed. Soon we're going to have it see the political. I don't think it's going to be a huge impact. But then again, we've seen a lot of changes over the last couple of years that we haven't seen in the past. So to be determined.
Got it. So who should people vote for? I'm just
Me.
kidding. Totally kidding.
Nicole, how does the regulatory environment impact the debt and equity markets?
As far as the regulations on banks, my background is actually working with regional banks. So I worked with banks that dealt with the impacts of regulation in 2008, 9, and 10. There was like the multitude of changes that came through after 2008 that just changed banking in general. Those are just kind of like it is today in that, when and I don't have any expertise in this area. So this is really more, again, just on how we see lenders getting things done or not. Regulations can make the smaller banks struggle a little bit more. The larger banks, as we've seen through COVID, actually were really super quiet. The regional banks were super aggressive. Whether that has to do with the different regulations based on the size of the bank, and again, I'm using mainly banks here because it's what are most regulated. You've got smaller banks. They have, like I said earlier, you have your internal cost of funds that create a lot of fees. It creates a lot of turmoil within the bank and figuring out whether they should lend or not. On the bigger banks, it's more on regulations. They have to make sure that their mix is correct. They have all different divisions that the smaller banks don't. So regulations, I don't know that they are going to be what changes lending on a whole, but they can do an impact. And what we're seeing today with the smaller regional community banks kind of not shutting down, but going on pause and staying internally is they're assessing their portfolios based on regulations and confirming that they're going to go through an audit somewhat smooth sailing. They don't want to be shut down. They don't want to get in the SVB situation, or signature bank situation. They want to say, hey, we're good. We're healthy. Maybe we start merging. How often do you guys hear of a bank merging? Frequently.
Mm-hmm.
And that's just because you've got two banks have similar background, similar tenant mix, similar client mix. And they are just saying, hey, we can offset a lot of our fees by merging together.
Well, and you've covered a lot, which has been awesome. And you've been in the business a while. Are there any, as we kind of wrap this up, any common mistakes that you've seen that over the years that investors should avoid, maybe other than overextending at the wrong time?
That's a tough one. I think, just sticking to a business plan, not trying to pivot too quickly, but being willing to pivot. We have a couple of our investors, again, smaller groups. And we're not talking about the really big institutional groups, but some of the smaller investment groups that I had a conversation with one the other day. They've consistently done industrial acquisitions. That's kind of their jam. And they just decided over the last 2 years, they've really struggled to be able to get in on any of the deals that are out there based on what we were just talking about earlier, all this value add, cap rates being too low, not being able to get the amount of debt that they need. So they've actually pivoted to another asset class in the interim. And, they're taking their time to understand it a little bit better. So they're going to look to diversify their portfolio. Again, much smaller group. Institutional, like you had said, the Panettones of the world, they're going to stick to their guns. I don't think even if they make a bad decision, it's going to affect them at the end of the day too much because they have enough knowledge and history to be able to say, we're willing to take that risk. And I would say historically, those risks usually pay off. But if you're a smaller investor, my suggestion is really do your due diligence, look at the downside, make sure you're good with the downside. And if the risk is high, but you have the liquidity and the ability to offset that risk down the road to the point spec industrial. What if you can't get tenants in, or what if those tenants come in at half the rents that you're anticipating? Are you still going to be able to hold on to that building? Does it make sense?
That's great.
Nicole, this has been just amazing information. I think the listeners are really going to enjoy this. This has actually been one of my favorite podcasts in a very long time. So thank you very
You're
much
welcome.
for being on the show and informing our guests of the current debt markets. Your information will be in the footnotes for people to reach out and contact you. But in case they're listening and they want to call you immediately, how do they get a hold of you?
Cell phone, I think, is the best for everyone these days. So if you're asking, it's 916-844-5450. Yeah, I would love to do this again with you guys. I really appreciate it. It's a lot of fun for me as well. But yeah, look
Thank you,
forward to getting
Nicole.
some stuff done.
Yeah.
Thanks
great
so much,
job.
Nicole. You were great.
Thanks all.
Thank
All
you.
right.
Bye.